Can you imagine what it must be like to handle an economic crisis? Or wondered how central banks tackle an event like a recession? With the risk of a global recession increasing every day, central banks all over the world are gearing up. How do they do this? They implement policies such as interest rate cuts, quantitative easing, and helicopter money. But how does it all actually work? Let's first discuss and understand how central banks use the interest rate to control the money supply. In an economy, there are two aspects of money. The first is the price of money, which is the interest rate payable when borrowing money, i.e. the price of credit, and the second is the total amount of money in circulation. The policies that the central banks use to control both the price and the amount of money are called monetary policies. The term might sound very simple at first, but it is not as straightforward as you think. Beware that the central bank mostly targets the amount of money rather than the price. Did you know that the interest rate on notes or coins is 0? Yet there are interest rates on the money kept in banks. Why is that? When the central bank increases or decreases its interest rate, other banks follow suit. This is because the central bank issues money that only other banks can use. This money is usually referred to as reserves. Banks can exchange reserves for coins and notes from the central bank. They can also use reserves for interbank payments. Banks that have too many reserves either try to increase their lending to other banks or hold their reserves at the central bank. On the other hand, the banks with very little reserves either try to attract depositors or borrow from other banks and central banks. This is how central banks hold power over commercial banks. Now that you've gotten an idea of what the banking system looks like, let's talk about the economic powers of a central bank. While central banks do not control all interest rates, they do have some control over certain rates. For example, the rate at which local banks borrow reserves from the central banks and the rate at which they can stash their excess reserves at the central bank. These two aspects directly affect the other interest rates in the economy. The second way that the central bank can influence the economy is by controlling the quantity of money. However, the local bank's ability to create profit is not something that the central bank can directly control. In actuality, the local bank's share of the money supply is by far the largest. So does that mean that modern central banks have no influence over the money supply whatsoever? No, here's what it means. Even though it is the commercial banks that gain profit when they lend money to their customers, there is a factor that directly influences the creation of money, and that is obviously the interest rate. It is only the central bank that has direct influence over this crucial component of the economy. This means that central banks can influence the money supply by changing the interest rate. Theoretically speaking, if the central bank raises interest rates to a very high level, then commercial banks will also have to increase the rate. In this scenario, only the riskiest borrowers or the big shots will dare to borrow money from the banks, and as a result, the banks will not create as much money as they would in an environment where interest rates are low. On the other hand, if the central bank decreases the interest rate, the commercial banks might feel confident enough to go on a lending spree. This is how the monetary policy works. When the central bank's interest rates rise, commercial banks are discouraged from making loans and profits. And this is what is called tightening monetary policy. On the other hand, when the central bank lowers its interest rate, it encourages commercial banks to lend money and make profits. This is called monetary policy loosening. Now, on what grounds does the central bank change its interest rates? In other words, what is the ultimate goal of monetary policy? For most central banks, the purpose is to stabilize inflation by controlling the price of goods and services. And so central banks make use of monetary policies to control inflation. And this practice is what they call inflation targeting. They usually set an inflation target of around 2%, and there's a pretty good reason behind this. Central banks believe that a bit of inflation is good, and it helps borrowers pay off their debt. Inflation also motivates people to spend more money, which creates a thriving economy. Thus, the central bank has primary control over a country's inflation rate. They can tweak the interest rate to achieve that 2% inflation target. Depending on the inflation rates, they can either increase or decrease the interest rates. The central bank believes that the level of inflation depends on the unemployment rate in an economy. And they have good reason to believe so because high unemployment leads to deflation and low unemployment leads to inflation. When there are lower unemployment rates, wages increase. This then leads to a lower profit. Companies will have to increase the prices of their products in the hopes of getting higher profits and thus creating inflation. As discussed earlier, the interest rate is the key factor that determines whether or not a commercial bank is capable of lending out money. A low interest rate encourages investment and spending, which shows that the economy is doing well and makes unemployment rates go down. But it also has cons. You see, when the economy performs well in an extremely tight labor market, inflation is very likely to rise above the 2% target. This means central banks will have to increase interest rates to slow down lending and help loosen the labor market. So, wages and prices of the products will stop increasing. Now, what happens if an economy is not performing well? There would be high unemployment rates and deflation. In this scenario, the central bank would have to decrease interest rates. This will increase investment and spending, which will then help economic growth. This is the rule that the central bankers follow when they determine whether the interest rate should go up or down. This shows us the influence of the central bank has over inflation and the labor market of an economy. Well, all of this sounds good in theory, but that has not been the case for countries like the United States and Japan. These economies have been experiencing high interest rates for over a decade now, with no improvement in their inflation. In particular, the central banks in Europe and Japan are finding it hard to reach their inflation goals. So, do these theoretical calculations make central banks capable of controlling inflation? There is no guarantee on this. However, there is a lot more to it. And because of this uncertainty, central bankers have started trying out new ways to handle money, like quantitative easing and helicopter money. The world might suffer a global recession in 2023, and when this happens, the central banks will play a major role in reviving the global economy, as they did in 2008. They could take a theoretical approach and change the interest rate. This might influence the quantity of money circulating in the economy and impact inflation. Their sole purpose would be to reach the target of a 2% inflation rate by raising and lowering interest rates. This is easier said than done, and we will surely talk about the practical approach in future videos. You think the central bank controls the economy through its monetary policies? I would love to hear your opinion in the comments below. If you've reached this far and liked this video, subscribe to our channel and click the bell icon so that you never miss any of our future updates. I'll see you in the next video. Until then, take care.